Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Wednesday, March 30th, 2022. It is 10:50 a.m. Eastern Time as I'm starting the video, so we have a few more hours to go today for just over 4 hours left in the trading session. And I want to do an update. We'll do a brief update on the equity markets and then follow up on some of the recently highlighted trade ideas, including the VIX, crude oil, gold, silver, the euro, U.S. Treasury bonds. I'll get to the pot stocks and anything else, time permitting, that I've covered recently. But that's the bulk of the trades right now that I'm in and have been thrown out lately. This is a monthly chart. This is about as long back as I'll usually go on the charts. Meaning every candlestick is 1 month, and we can go back decades here. And the key features, this is just kind of an update for those that are, already been following me for a while. But we always get new people coming in from time to time, so I just bears repeating. This is one of my favorite charts, at least for the longer term, the big picture, the primary trends. And so what we've had here, in my view, is we've had only two bear markets in recent decades, and that is the when the dot-com bubble popped back in 2000 into the 2002 lows, late '02 lows. It was about an 84% drop in the Nasdaq 100, and then we had what they call the Great Recession. That big bear back there was about a 55% drop in the Nasdaq 100, about the same in the S&P. It doesn't look like much because this is log scaling. Again, we're going back all the way into the early 90s on this chart. And then along the way, you've had little corrections. Well, not little. They vary. They're all double digits. And running again up to the bear markets 55, 84%, and then the corrections about 20, 30. You can see 20-ish, almost 20, 20, 30, right there, and even COVID. And then what I measured there, the reason those drops are measured, it is because this is one of the most reliable trend indicators out there. There's a couple, two of the most reliable trend indicators that I've ever seen and I've been using for years, and that is the PPO histogram. It's so simple yet effective. That's these green and red bars here, and they show you visually the differential, or the difference between the PPO lines. So when the lines cross, you get goes from green to red, and without any exception, and this holds true on the S&P 500. This has a 100% accuracy rate. It is not a timing indicator. I have to say that. It's not going to get you in. It's a monthly chart, and you need to wait till the monthly candlestick closes. So usually it's going to get you in, after the top, certainly after the top, and get you back long or covering your shorts after the bottom. But it kind of gives you an idea where we're at and where we might be going. And so again, without any exception, I've measured out all the corrections that coincided with a red crossover. You probably can't see it in the video. You just can replicate this on your own. If there's a correction measured, there was a bearish PPO crossover. And again, I didn't miss any. So there's no whipsaws. You never crossed over. And you can see them already measured out. In recent years, again, we had the big Q4 2018 drop of about 24% high to low in the Nasdaq 100. That was associated with the crossover. We had even COVID. It was a 1 month solid crossover. You got the confirming signal, but the Fed made sure that one was over just as quick as it started, but it was still a 31% drop. And then there's this one. And the point is, when we do cross green, then it's safe to say, in hindsight, of course, but it's safe to say that the correction or bear market is over. Back there, that's when we crossed, not too far after the bottom was out over in 2009. Sure, there was a pretty good run above there, and we still hadn't taken out the previous highs from the bear market, but it said, hey, get back in your 401k, get back in, don't be short. And there it was. And then not just the crossovers, that line does a beautiful job of acting as support during a bull trend, and then resistance during a bear trend. Once you cross it, kick back. So look, we haven't crossed that yet. That's going to be a much more powerful sell signal when we get it, and it will, if we get a closing, a monthly candlestick close below it, it will help to affirm or confirm my still ongoing preferred scenario, primary scenario, that this was most likely the initial leg down in a bear market with more downside to come. And of course, my targets on the weekly charts, they mesh roughly with these. You got a trend line, big primary. This is your bull market trend line. So again, these, even though that was 31% when COVID hit, the drop, 24 back there, 26, they were just corrections. My definition, the old 20% drop off the highs being a bear market, that's antiquated. That's 1930s, 1950s stuff. In this day and age of an aggressive Fed that will do anything to support the equity markets, volatility reigns king. It's high. And so again, when you look at a simple trend, you turn off all the lines, or well, you can leave them on. There's your trend line. That's an uptrend. Again, I think that old, definition of a bear market, 20% needs to be revised, and it's also specific to each particular instrument. There's things, if you're looking at natural gas, even on a daily chart, look at a trend over a year or so, you get 20% up and down moves all the time. Sometimes in 2 days you can go up or down 20% and things like that. So again, you need to, every security is different. And the tech heavy and more volatile NASDAQ 100, again, that's just my definition. So far, we had about a 22% drop. That's why I have question marks, meaning, is that it? I still say there's decent evidence to say no, but until that 20-month goes, and of course those recent lows, we double tested the lows, it's anybody's game. So that's why we're going to look at the short-term charts. I just wanted to show you this is what I like to revisit from time to time. And keep in mind, usually when you get too far away from this trend line, you'll come and visit it, the primary trend line. So even that, and if it happens, we happen to visit it this year, like I think it'll be sometime in 2022, you're talking a 32% drop. And again, that would only be a correction if and when we hit that anytime soon. Oops, I moved that line. All right, let's move it down, walk it down to the shorter term time frames. There's the, right here, this blue line is the 200-day simple moving average, and you can see where that candle is. Look at that intra-week check. We had an intra-week pop, but we're back down below it right now, meaning we're certainly, it's coming in as resistance, just like last week, the 200-day exponential capped the advance at the end of the week. We'll see where we go. Again, this is as good as any place to expect a rejection if we're going down lower. Even if you're going to new highs, there's a good chance you're going to see a lot of sellers step in here. And again, that's another one that's just done a great job. Turn off all the lines here, and it just tells you when it's taken out. You're in a bear market, and when you regain it, hey, guess what? Usually, I'm sorry, not a bear market, correction mode. Usually, boom, then you're good. And when you're in a bull market, pullbacks to those 200 days act as support. They're great buying opportunities, but again, when you break it, you broke it here, and it was a couple weeks later, a couple months actually, a month and a half or so later, you back tested it, and that was again back in 2018, and that was it. So there was a nice rally, just like similar to the one we're having now. We ran into the 200 after we took it out, and boom, another leg down. And again, just really technically just a correction at that point in time. And then finally stepping down to the 60-minute chart. This is more of our especially the realm of the swing trader and active trader. Again, like I said, if you wait for buy signals on a monthly chart, it's going to come way after a bottom, and if you wait for a sell signal, way after the top. But it does help to kind of look at the bigger picture and formulate, okay, what is the trend right now? What is it likely to be? And that's why I'll look at those charts, and then I'll determine whether to short rallies into resistance or wait for a breakout to buy and add to long positions. So right now, about 369.88. You can call it 370 if you want. That is resistance on QQQ. As you can see, some reactions along that level, including right now. We're on a 60-minute chart, so that's just a different moving average down there, the yellow one. And as I got out to you this morning, I have these, this is the trend lines I'm watching now. I think will do the trick. So we're effectively right on that trend line now. Need to take that out. Need to take it out with conviction. And looking at this right now, if I look closely and turn off all the lines, let's just say we hold up today, close flattish. You have the potential right here. Just notice this. There's an island. If we gap down tomorrow, if we didn't break down today, but we broke down via a gap below the trend line tomorrow, and it looked like this, then you would put in what's called an island cluster top. And that is when you have a cluster of candlesticks separated by gaps on each side. And they're fairly reliable. One of my favorite reversal patterns. You can also get them bullish. If you're falling in a downtrend, then you have a big gap down. Either a single candle would be an island reversal, or a cluster of candles and then another gap up. And they're pretty good bottoming patterns. So it's only a potential thing. We'll watch it. And like I said, there's a lot of potential things out there, but that's one to look at. I'm going to clean this trend line up. I had it in pre-market and it was a little too tight. It shifts when the pre-market trades turn off. So there it is right there. And now you have quite a few reactions and price resistance here. So that's QQQ. I gave you the futures as well today. This is NQ. Bigger picture was the bullish falling wedge, that downtrend line breakout and the divergent low. We broke out there, been stair stepping up, but then to get a little more granular, zoom in tight. And this is the divergence that's been building. I've been talking about it now for a little while. We continue to build. It's still intact. And so here's the trend line off the recent lows. That's comparable to the one I just gave you on QQQ. I think that needs to go. There is a secondary trend line that comes in right there, but that also comes in with that price support about 1500 or 1524. You can see that there. You can also see it if you zoom down, which I'll do right now for you on a 5-minute chart. This is that secondary trend line right there that I just showed you. So if you're trading on the 5-minute time frame, and it's done a great job of, for active trades, especially with volatility being high recently. You can see the divergence there on the 5-minute chart, at least up to that point. Any equal or marginal new high now will still have the divergence. So boom, that one needs to get taken out. And let me just flip back again to the 60-minute, show you. I'm referring that one I just showed you on the 5-minute chart. That's it right there. So yeah, that would be a BOD level right there, what I call benefit of the doubt. So you might break that trend line, but then you have some secondary support right there. If that goes, then the odds are pretty good you're going to move down and hit any or all of these downside support levels below. And ES, the S&P 500, you can see it nice and clean. I don't have a lot of lines on this chart, just the uptrend line right there and the divergence line right there, giving us that wedge pattern. And there's your targets, 41, 45, 11-ish, 4409-ish, initial targets. Expect a reaction on the first one, followed by another leg down, probably hit that target at minimum again. And the fact that if that does happen, and it happens soon, remember it's going to be rejection off the 200-day moving average, and it could prove to be the end of a counter trend balance and a much larger downtrend. So that's where, if you think that's possible or likely, or you want to try to trade it, this trail stops down. You get in, and as the position grows, you can continue to let it build, which it's like what I did with crude yesterday. That played out well. I told you to reversed it when the final target was hit. I'll get to crude in a second. Let me just update VIX, since that's more related to the stock market here. This is VXX. Remember, this trade, the last trade, gave us a perfect hit of the final target right there. Well, actually perfect. Remember, these are all actual support or resistance levels. You want to set your sell limit order slightly below, and that's what that did. So we hit the final target there. We're able to get out and avert that big give back, and then I added it back here the other day. This is the actual first target level right there. It was resistance based on my charts back here, all these levels. We hit it at this point right there, and I forget where the long entry was, over here somewhere on that one. Anywho, so that was it. We pulled back, and we've been holding that support. So while the market continues to act like it's running up toward new highs and the correction's over, the VIX is saying otherwise. It's holding support as of now. And again, it was simple stuff. You can take a relatively, I keep using the word relative because relative is how much. This was 100-something% gain on this trade. So if you were targeting T5 to begin with, you could have given yourself a 25% stop loss or plus or better than that. and still had an excellent 4-to-1 or better risk reward ratio. So everything's relative, and it's relative to what your price targets are, to the volatility in the security, et cetera, et cetera, et cetera. So this one, since we re-entered, the trade's already been successful in the fact it hit the first target, which some of you may have taken profits there, and we just came back to entry right now. We had, as expected, that's why multiple targets are listed. Not always guaranteed, but reactions are likely upon the initial tag of each target. So if this one plays out as expected, now we should soon get a breakdown in the equity markets via those 60-minute charts I told you, and then head on up here and go on, run up the next target, T2. And depending on how it looks, sometimes the VIX can just explode. I can tell you this, that's why I have these potential third and fourth targets. If we start making a run at those the recent lows, that double bottom in QQQ, and we take out the wedge, that 60-minute bullish falling wedge, or the downtrend line right here. Here it is on a daily chart, or I can show it on a 60-minute chart. Yeah, my expectation is that's where you start to see selling will accelerate. You'll zigzag down for a while, dip buyers will buy, but then the closer you get, we have no business. We've rallied up enough that if we get down there again, we'll probably slice on through there, would be my guess. And what does that mean? So it tells you, if that were the case, that's where the markets would probably be going down very sharply, and then the VIX could explode to the upside and hit those targets. Remember, they're very aggressive targets, and that's why I labeled them potential. I need to see a little more evidence here. I need to see, we've already taken out some previous reaction highs on the indexes, especially the S&P 500, which does put a damper in the whole case for my longer term targets being hit. It doesn't eliminate them, not yet. There's still levels that haven't been taken out that we need to take out to really greatly reduce the chance those targets are going to be hit. But anywho, this is to just put it in perspective. If the second target's hit, that's a 43% gain. And if my third potential target right now, that's 72%, then 104, and then about 155% if that fifth target's hit. Okay, quick update on crude oil. So got this one out timely yesterday. That was our short entry there. Hit the fourth and final target. Mentioned going long, reversing. Somebody asked me right after I made that post, hey, what are you, I had my initial arrow drawn up to 101.90. That was my minimum target. And then I stated, what, I'll just go ahead and trail stops up and let it run. And why I did that, and this I added this after, we had, by the way, at positive here. Let me go to another board here without all the targets. It gets in the way. This is the one I was covering yesterday. It's the same chart. That's a 5-minute chart. Let me go back to the 1 month, 60-minute hourly candles. And that was it. That was the target right there. Covered just above, reverse just above 98. And you can see we had nice positive AK bullish divergence as well. And that's what you do here. On this is wash, rinse, repeat. Swing these divergent highs and go short. Divergent lows, go long. Divergent highs, and of course trend line breaks. Divergence in itself is not a buy signal. Two objective ways to go long: either pull back to support if you expect a bounce, which obviously I did. So my final target was there, and you can also go on a breakout of some type of like a downtrend line. For example, there was a breakout in a back test, and so far for those that did reverse and caught any of that, that's now in a day you made another. You turned around, took a 20 or so whatever percent drop, successful short trade, and added a 10% bounce. I'll tell you, it got me right here. I had a trailing stop and left it in place about 1.3%, I think it was, and that's where they took me out. But now I'm just doing an update. I turned around just before the video. I shorted it. I have some resistance. I'll tell you why. I have some resistance here about 108.68. You can see that line right there, especially these recent reactions there. You also have a wedge pattern. There's no divergence on the wedge, but you do have the PPO rolling over. And then on that 5-minute chart, let me see if I can get to that. show you what it looks like there. You've also got some divergence forming here on the 5-minute chart. There's an uptrend line off the recent lows that needs to go, and a secondary trend line, and then some price support as well, about 107. So I took a small starter position. I'll add to it at 107, and need to add a level here. I'll just as of now, I'm probably just going to put a hard sell limit, not trail down a stop. If it gets down here, minimum target would be right here. I need to add this in. I can see these, but then sometimes I don't put the line. 105.50 and then 104. I think 104.66 was a good shot. We'll get a pullback, and I'm keeping stops tight on that one because it needs to stay. You can see the resistance pretty well here, 108.77 right there. And so, boom, that's what I'm looking for. Pull back to there, possibly right there, and then who knows from there. Sometimes that's it. I get out, I stand aside, wait for the next setup. All right, moving on. Gold. I give you hard buys in gold. I really liked where they were at yesterday based on both the support on GLD or GC. This is gold futures. Good, really good support there at 1895, and so far so good. Plus positive divergence, and then what happened with the euro. There's a potential trend line here, back test, but it looks like we're regaining that now. And again, I'm just sitting tight for the time being on these. I think there's going to be more upside and maybe substantial upside, longer term. And that was silver. Again, I already covered these yesterday. Silver was along here off support. If you took it, there's already a trend line. I'm trying to just measure out. I got to drag it and put it here like that. That's good for almost, I got to pull it down. Yeah, about 5.2% so far bounce off that trend line. Pretty nice. And then the big part is too, a big factor in going along there, especially pretty aggressively, is the breakout in the euro. So I went over this yesterday. You had that beautiful bullish falling wedge pattern on the 60-minute chart with positive divergence. Popped it, hit my first target almost perfectly. Had a reaction. I told you I didn't think it would be a very deep reaction, and we'd come up and then take it out, and we did. So that's it. We took that out, and that should, quote unquote, we'll see if it happens, open the door for a move up to my next target at 113.26. Maybe we back test the level, maybe not. Tiny little divergence, little baby divergence right now. I don't know if that's going to play out or not, but I'm not going to fret it. Like I said, then we got some good entries on gold and silver. If they take out yesterday's lows, then the rally's probably done. So you can have a stop above just below yesterday's lows if that's where you took it off support, or at this point you could raise those stops and assure at least a break even or a profit on the trade. That's up to you. Treasury, ZB, I'm using this chart more than the TLT. I'll go to TLT for the bigger picture, or TYX, the 30-year yield. But remember, those you're looking at 9:30 to 4 p.m. trades. You're looking at round-the-clock trades. Treasury bonds, U.S. Treasury bonds are very liquid and widely traded security, especially the futures. So you're going to see levels that you're not seeing elsewhere, things you can pick up on the charts, downtrend lines, divergences. And also, most importantly, you got to buy a boatload of TLT to make, a pretty penny dollar-wise, because Treasury bonds don't move up and down nearly as much as equities do. So you have the leverage that ZB affords you. There's our bullish falling wedge, the breakout. We hit my first and second targets have been hit. We hit T2 and reversed, had a pullback, and here you probably can't see well in the video. Zoom in a little bit there. There it is. Hit the second target, pulled back, and we're stair-stepping higher. This is all the makings of a near-term uptrend. Higher lows and boom, 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 higher highs. So we already hit my second target, 150.40, and so now we need to take it out. If we do, it's going to be another check mark. It's going to give you a new higher high and should open the door to this 151, 146 target. Okay, and a quick update on the pot stocks with the equity markets still hanging in there as of now. The dash trash continues. Plus, remember, these had constructive charts. So I wouldn't just buy something a lower quality stock just because everyone else is buying low quality stocks. That's what's popping. No, the charts were constructive. That's why I threw these out there. And so far so good. Remember, these a lot of these popped big the other day in after hours. That's why it says T3 hitting after hours. But we're moving up. If you look at just even the regular session trades, this is a pretty clear near-term uptrend. Pretty much, looks like almost straight line up. And that's it. So, just trail stops, and as long as the sector continues to catch a bid, there's a good chance we can hit the final targets. If not, then you should at this point in time, if you took them anywhere where they were first mentioned, or on certain ones when they broke out, you should be profitable. All these trades are profitable by a good amount right now. These are all the ones I covered. HEXO, T1 already hit. TLRY, T1 already hit right here. Continues to advance. Looking up here, T2 zone runs from 990 to 1058. CGC, T1 was already hit. T2 was hitting after hours. Again, still moving up, and you can, if you wanted a very tight stop, you could have a break or a daily close below that uptrend line. CRON, same thing there. ACB, same thing there. They don't not labeled, but right now, let's just say 536 be the final target. Maybe all the way up here to 632. Again, as long as there's momentum in the sector and the stock market's going right now, I consider this somewhat of a hedge. As you guys know, I'm short the equity markets via NQ and RTY, the small caps, which I forgot to cover there. But and this is a hedge. So if the markets keep going up, traders are going to keep bidding up these low quality stocks. And these will probably come on up here, and ACB could come up all the way up to that 632 level, or any of these other ones. So MJ is the ETF. Again, for those that just want a one and done, easy diversification, has all the names that I've already just gone over, and it continues to move up, and it's already hit that 1095 target, and still have a potential target up here at 1268, and then TGODF, boom, hit that 1270 target, and that would be your right now the final target up there, about 1583. Okay, I'm going to end the video here. I meant to cover the small caps before. I told you this was a big level to me, this year-long trading range right there, with the failed breakout attempt above it. Then we had our major sell signal, the breakdown candle, hit the first target there. Tested that low on a few different times, so we're in the a trading range right now, and we're back testing it. So back here, when we first back tested it the week of February 11th, I told you that was an objective, very objective shorting up, and it was, and we got a good 10% or so drop from there, and that's it, and we're back there now. So I maintain that this is a weekly chart. Got to give it room when there's a lot of volatility. If you use weekly candles, it's going to help you keep you in a trade, because a lot of times, almost always, you'll take out the key moving averages on an intra-week basis, only to close back below them or on them that week. Same with big resistance levels. So right now we are so slightly above that, and again, it's a rough level, about 209.23, that I'll be very interested to see where we close the week. If we put a big green candle this week and we close way up here, you're still closed on a moving average, but I'll tell you, it's hard to chalk that up as anything but bullish if you recover that the bottom of that trading range on a solid weekly closing basis. Unless that happens, I think it's an objective area to short. And again, objective means, look, you take a shot here, keep your stops tight, relatively tight, again, and maybe on a weekly closing basis. And the risk reward, if it does get rejected here again, and we do go on to hit my second, third, or fourth targets, you're risking 5% or so to make 32. That's a phenomenal risk reward ratio, and better than 6 to 1. All right, guys, I'm going to wrap it up here, and Yeah, if I see anything else that stands out today, I'll get it out to you. The only other thing I didn't update was lumber. It's only one of my trades sucking wind today. Where is that? But it's still actually above entry. I took it on the bullish falling wedge breakout. We're right back to break even almost. That's where the wedge broke out right here. Big red down candle today. That's not ideal really. But again, there's support right there. The recent lows needs to hold that, or let it go. Don't fall in love with this or any other trade. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.